$40 billion global equipment manager Honeywell seems to have an understanding of the world economy. Despite market volatility, the company is seeing profits rise better than 25.5% over the past 5 years on average. The company has been an outperformer, outperforming the S&P 500 and industry peers like General Electric and United Technologies for an entire decade. Joining us right now at a Fox Business exclusive is the chairman and CEO of Honeywell, David Cote. David, good to see you.
Nice to be back here.
Thank you so much for joining. Wow.
By the way, it's still a good time to buy.
What? Buy your stock. Look at your performance. 26% in terms of gains in earnings, 26.5% rather, over the last 5 years on average. Congratulations.
Well, thanks.
To what do you attribute that?
We've done a lot over the last 14 years to transform the company on portfolio, the work we do on process, and importantly, the work we've done to improve the culture. And we've done a lot of seed planting over this period of time. I've often said you do well this year, not because of what you're doing this year, but because of what you did in the previous 5 years.
Yeah.
And we do a pretty good job of that seed planting on products, geographies, process. I mean, we really work on it.
And all the while you had been accumulating cash, so much so that the analysts were coming to you and saying, look, you know, how are you going to allocate that cash? So you did a lot of deals, $6 billion worth of deals last year. Yeah. So I want to ask you.
Who would have thought having money was a problem?
Yeah. Well, at some point, I guess when there's all that cash on the balance sheet, investors want to know.
What are you going to do?
Well, how am I getting paid?
Yeah.
Right. So before we go into some of the deals and what you're looking at next, let me ask you about the environment, broadly speaking. Caterpillar this morning lowered its guidance for the first quarter. Actually, it was pretty dramatic. They're now looking at earnings per share of 65 to 70 cents versus an estimate of 97 cents. Stock is looking down this morning. They're talking about weak demand.
Yeah.
What are you seeing in the first quarter?
It kind of varies by sector, but I'd end up, I guess the way I describe it overall is it's still pretty much a slow growth global environment. It just is. It's been like that for, well, this is the 6th year in a row. And I don't think it's going to be any different for the next couple of years. It's just that way. And some sectors will be up, some down, but on balance, it's slow growth. And that's what we're seeing. Which
is why we saw the worst beginning of 2016, worst beginning of the year for the stock market anybody has ever seen. But it feels like now recession fears have begun to fade. Is that a fair statement?
Yeah, I would say in general there's less recession fear than there was, say, 3 months ago or 6 months ago, because it used to be there's a global recession coming. No, there's a U.S. recession. No, it's an industrial recession. And I think each of those has kind of moderated over these last 3 to 6 months. That being said, there are some sectors that are really struggling, like the one that Caterpillar is in. And Doug's a good guy, and that's just he's just got a tough time to deal with here. One
of the big issues has been the price of oil dropping as much as it has. What's been the impact that you've seen from oil where it is? And even today, when you look at it close to $40 a barrel, you're thinking, okay, well, this is good news. It was all the way down to 20.
Yeah, this is going to be, I've been actually a little surprised at how some of this is developed, because the oil value chain comprises 2 pieces. The exploration side, that's driven by a commodity price, and then the mid and downstream side, which should really be driven more by end demand. And this is the first time that I can ever remember where people are talking about low oil prices being a problem. Because in general, low oil prices cause consumers they get more money in their pocket, they spend it. And up to this point, they're only spending about half of it. The rest of it they've been saving, which is not necessarily a bad thing.
Right.
But we've got this odd dynamic going on right now, and that exploration side is really hurt, that demand fall off has hurt a lot of companies.
And we've seen bankruptcies in the shale business. We've seen job cuts in the energy sector. Do you think it gets worse?
It's tough to see it get much worse. I mean, drill rigs are down to 400 or 500 now, down from a peak of about 2,000, I think it was.
Right.
So it doesn't have a lot further to go.
Let me ask you about your own plans. I mean, for a while you were looking at smaller private companies in terms of where you were doing acquisitions, but you've obviously changed the strategy a bit, acquiring larger companies. Does growth in the next 3 years come from more deals or organic?
Well, we're going to do both. And I always have plan A, which is just driven by what we do organically. Because I like to know that no matter what happens, we're going to be fine. And the last thing I want is people in the company starting to feel like, got to get a deal done, because if we don't, then we're not going to do well. So I've always looked at it as organic growth plus whatever you can do. So that's why I never feel compelled to do deals just for the sake of doing deals. Unless it makes sense, we don't do it. And as you know, I was getting a fair amount of grief from analysts for a while about when are you going to deploy the cash. And I kept saying, well, I got to wait for good deals. And when they come up, then we'll do it. And last year we did $6 billion because a bunch of things came together. So who knows what happens this year, but last year was a very good year for deploying cash.
And you were very clear that one positive would have been, for both shareholders, a deal with United Technologies.
Yeah, it would have been good for both.
And so what happened? You finally decided, after lots of pushback, to walk away. United Technologies didn't want to do it.
I would say they definitely didn't want to do it. I mean, the
understatement.
I met with them on Friday. They leaked the story on Monday and were very aggressive in talking about all the problems with it. None of which they felt were problems when they were trying to go the other way and acquire us. And I just said, oh, okay, well, it's not worth it. This is a chance to make a lot of money. I made a good offer, and I had some analysts saying, you know, at 120 this deal gets done, and I would say at 120 this deal does not get done, because I'm not going to pay for the privilege of making everybody a lot of money. This just doesn't make sense, so we walked away.
Sometimes it feels like deals don't happen just because of egos. You know, the CEO is afraid that you're going to just run the whole company and he's going to be out of a job. Does that play into this stuff? Oh,
I'd say absolutely ego makes a difference. There's no doubt about it.
So, I mean, I remember years ago we used to talk when people speculated that Honeywell should merge with General Electric. I mean, we've been talking about a mega deal for Honeywell for a long time.
Yeah.
Do you need a mega deal? Do you need that kind of scale to see the success that could happen?
No, because if you take a look at what's happened to us over the last 14 years, our market cap has gone from 20 billion to 83 billion. We've become a very big company during this time. Our organic growth prospects, because of the seed planting we've done, are extremely good. I view this purely as a way to make even more money for our share owners. But if people don't want to do it, they don't want to do it. So move on.
Which industries do you identify as the big drivers of growth in the coming years?
Oh, for us?
Yeah.
It'll be all four of the kind of major business areas we're in. So controls, turbochargers, what we're doing on the performance materials side, and aerospace. Every single one of them is going to do well.
Aerospace, I mean, this is our, what is it, one of our most important exports, obviously, airplanes. Yeah. How's that going, given this constant talk of trade and issues over trade in the election, certainly?
Well, I think the big dynamic to look at, kind of the overall, what's the indicator you want to watch in aerospace, is just flight hours. Are people around the world flying more this year than they did last year? And if you look at that, that trend is pretty consistent. It's always up 3 or 4% a year. When you get to a recession like '09, it's down 1 year. 9/11, those 2 years, it was down 2 years in a row, which is the first time ever. But if you look at that 60-year trend, it just keeps on going. That's going to keep happening. Now, there'll be some bouncing around with OEM production, for example, and there'll be other dynamics people have to deal with. But that trend is real, and that's not going to disappear.
Dave, real quick, what does business want in the new president? I mean, here we are talking about Donald Trump and Hillary Clinton every day. Your thoughts?
Economic growth. Yeah. We need fiscal policy and regulatory policy to be consistent with what companies need for economic growth. That's what's going to drive employment. That's what's going to drive wages, because at 2% economic growth, most of us can just be productive enough every year to not really have to hire as many people.
David, it's great to see you.
Yeah, nice to see you.
Thanks so much for joining us.